All right, we have markets that are showing green arrows now after CPI came in bang in line with expectations. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, core inflation eases for a fourth month in the United States, keeping the Fed on track for a cut in September.
And we have one of the biggest deals of the year. Mars scoops up snack maker Kellanova for $36 billion.
And the push to break up Google. We've got the latest as the DOJ considers a rare antitrust move. But let's take a look at where markets are trading 30 minutes until the opening bells and 30 minutes after we got that CPI print. As Matt said, green on the screen right now. Not huge moves, especially relative to what we saw yesterday. But the S&P 500 up about 0.2% right now. Same thing, too, if you take a look at big tech. Of course, not doing too much to alter those bets on a September rate cut. Meanwhile, the bond market, you did see a move out the long end, but currently 10-year yields retracing a little bit. I'm going to go ahead and call that unchanged, Matt.
All right, I'm taking a look in depth at the CPI, at the inflation report. I'm using the function on the Bloomberg terminal, ECAN Go, E-C-A-N Go. If you pull that up, you can get data for CPI, PPI, non-farm payrolls, what have you. I've clicked in for a deeper look at the shelter component, which is this amber box here. You can see it's getting smaller and smaller, but maybe not quickly enough. We'll talk to Mckee about CPI in just a minute.
Let's look at those pre-market movers as well. We were talking about that mega deal, Mars agreeing to buy Kellanova for nearly $36 billion, and it'll bring together two major food companies in one of the biggest deals of the year. And Kellanova shares up more than 7.3% on the heels of that. We're watching shares of Starbucks after its record surge yesterday, adding more than $21 billion in market capitalization on the heels of a new CEO announced, but now down almost 1%. Nvidia also being watched here. Shares moving about 2% higher pre-market. Remember, they've surged 17% in the past four sessions, adding nearly $424 billion in market value, Matt.
All right, we are looking at, I would say, kind of a muted reaction to the CPI numbers. Very important to get this look at inflation. Of course, we're also going to focus on the labor picture with unemployment claims, and then at the beginning of September, the non-farm payrolls number before the Fed makes its decision. I think when we get cooler and cooler inflation numbers, it lets the Fed worry more about the labor market. So it takes this more out of focus, in a sense.
Mm-hmm. And I mean, you made the good point that there's still a lot of data to get through before we get to that September Fed meeting. But when it comes to this market reaction, just the one-day tick, you could argue it was priced in. We got the PPI numbers yesterday. We saw that huge rally. And now we got these numbers bang in line.
How much does it take 50 basis points off the table is what I want to know, because there were still
Was it on the table at some point?
Well,
I mean, all the economists that we surveyed,
80%
80% of the economists we surveyed say 25 basis points.
Economists versus the market at all times, Matt.
All right, well, let's ask Mike Mckee. He knows all the answers. He's our Bloomberg Chief International Economics and Policy Correspondent. 50 basis points?
We'll get to that in just a moment. The market is adjusting, but we did get a bang-in-line number, 0.2 on core, 0.2 on headline, and that's why you're not seeing as much of a market reaction, because that was priced. But the good news is, on a year-over-year basis, because of rounding, we dropped to 2.9% on headline. First time in the twos since post-pandemic for CPI, and headline core CPI, rather, on a year-over-year basis, 3.2%. That's a decline as well. So overall, inflation is well behaved. Now, Matt brought up ECAN at the top of the show. I want to go back into ECAN and look at where we see the big moves. And the yellow there is core services, which includes housing. And that's 90% of what happened this time. Basically, housing prices went up 0.4. That's a little bit more than last month, and that really accounted for almost all of the increase that we did see, the 0.2 increase that we did see. Now, to your question about what does the Fed do? Markets think the Fed at this point is still looking for a little more than one move, but not a whole lot. We have come off that idea, as you can see there. Number of cuts priced in under overnight index swaps, and now we're down to 1.3. We were at 1.5, and as you can see back on August 8th, and then you go back all the way to after the jobs report, and we had more than 2 priced in. So markets are backing off the idea of 2 rate cuts. But remember, we get another CPI and we get PCE before the next meeting. And the other real issue here for all of us, including the Fed, is politics. It's an election year. So what is happening with overall inflation? You take a look and you can see that inflation, the blue, is coming down on a month-over-month basis, CPI, but the level has only just sort of flattened out, maybe gone up a little bit, and you can see the red line there gives you the trend line. So voters are looking at the white and red lines, and economists and Fed officials are looking at the blue lines, and they've got to close that gap before anybody can get elected.
And what's fascinating here to me, too, is you have this inflation print this morning. This was supposed to be the big moment of the week, but there are a lot of people that are watching, and you pointed out earlier this week that tomorrow might actually be more important with the retail sales, and then many also looking at the jobless claims numbers.
If we don't get if we get a major move in retail sales, especially to the downside, then that could move markets more than we're seeing with CPI today, because it feeds into the narrative of is the economy slowing too much? Same with jobless claims, if they happen to jump up. But we probably aren't going to see a resolution to the idea of 50 basis points unless Jay Powell comes out next Friday and says not doing it, until we get the jobs report for August in September. That'll set people's expectations for what the Fed's going to do.
All right, Mike Mckee, really appreciate the breakdown as always. That, of course, is Bloomberg's Mike Mckee. And let's keep this conversation going now with Amanda Agati. She is the CIO of Asset Management over at PNC. So come into this debate, 25 basis points versus 50 basis points in September. Does it really matter, the magnitude, or just the fact that we're starting?
Oh, I absolutely think that it matters, but we're very much in the camp of it being 25 basis points as opposed to 50. Of course, the market is leaning towards 50. Market wants the sugar high, craving more policy accommodation, but the sky's not falling. The market thought the sky was falling, but based on the data that's been coming in, it's hashtag choppy, but not falling precipitously here. And so we think 25 is the right first step towards easing policy.
Is that enough for us to continue this rally? I mean, we've had a great, I think the best 4 days of gains on the S&P so far this year after, I mean, speaking of choppy, last week was tough, but if we get the Fed starting to cut on September 18th, can we keep going to 56, 57, 5,800 on the S&P?
I think it's a tough slog, to be honest, in terms of keeping this rally going from here. For all intents and purposes, this market is still effectively priced to perfection, despite what happened with the sell-off and rebound. It's almost like it was a distant memory. And so there isn't a ton of headroom to keep this market rally going without seeing a really significant rebound in earnings growth expectations. And Q3 is kind of starting to look a little bit weak here. I'd like to see that rebound in terms of revisions, and so far it's going in the opposite direction. So I think that may very well be more of the key to keeping this rally going.
You know, I hate talking about the past, Amanda, but just over a week ago, we really saw a pretty significant one-day decline in all the major U.S. indices after really steep declines around the world. And you do have some fear under the surface still. Can we still see some shocks given where leverage is, given where positioning is? Do you have to be prepared?
I think you always have to be prepared. It's the things that we don't see coming, right, out of nowhere that certainly send some shockwaves through the system. I don't know that there's anything in particular at the moment that's bothersome here in terms of, you know, catalyzing a significant correction. It's really more about the fact that I think global economic growth is still quite weak. We're starting to see some movement in terms of central bank policy accommodation. Fed's last in line. It's very unusual for the Fed to be last in line. So they need to join the party here. But as long as they start moving here, I think it can help stabilize the backdrop.
And how does that filter out in terms of how you want to build a portfolio around that? I mean, I know that reading through your notes, you've been pretty defensively positioned. I mean, after we start to see that rate cutting cycle kick off in the U.S., is that the green light to maybe move out to maybe some more cyclical areas?
Oh, absolutely. I'm chomping at the bit to try and back up the truck here in small and mid and value and certainly cyclical oriented exposures. It feels a bit early, though. And so from a defensive positioning perspective, it's not like we've been sitting on the sidelines with a ton of cash. We've been fully invested, but our exposures tend to lean more quality, dividend growth oriented. There's been some minimum volatility exposure to help create some ballast in portfolios, which was really helpful in the middle of the sell-off, and we're leaning investment grade and fixed income. So I would like to move towards cyclicals. I would like to move towards some more below investment grade credit exposure, but just not yet. It's a little bit early to make that move.
Are you worried about the consumer, Amanda? We've gotten some I guess, concerning reports in terms of big ticket items like travel from TripAdvisor, Airbnb. We've gotten, not encouraging reports from Disney in terms of the parks, and we get some retail numbers out this week. How's the consumer look to you?
The consumer is starting to exhaust itself. It is not hitting a wall per se, which is good news, but I think the consumer is definitely starting to exhaust itself. And so there's still a lot of activity happening on the services side of the equation. You see that in the CPI print for sure, but definitely there's some trading down in terms of behavior that's happening there. It's natural. It's late innings of the cycle. We've been spending like gangbusters these last few years post-pandemic. So I think it's natural to see that start to fade a bit here. I think back to school shopping is going to be really interesting to see what happens from a consumer spending perspective. Certainly holiday shopping. I can't believe I'm saying that since it's August, but I think we're going to get some more clarity on health of the consumer going forward, but we don't see this big wall right in front of the consumer here.
Some of these big consumer names are really driven on some significant and event-driven activity. You look at Starbucks, you look at Kellanova today, and there's a sense out there that this is a stock picker's market. Do you buy into some of these moments that M&A or spin-offs or other event-driven moves are giving investors a new opportunity?
I always feel like it should be a stock picker's market. As a former equity analyst, I'm all in on the idea of stock picking. And so certainly event-driven opportunities can create some interesting actionable moves for investors. It has not been much of a stock picker's market this year. It's really been the top 5 or 7 names that have been the only things that matter. And so active management has definitely struggled. But I do think that as we move towards Fed policy accommodation, an inflection point in the cycle here, it is going to create some more opportunities for investors to get really active and be less focused on just broad beta exposure. As it relates to some of the deals and what's been going on today in particular, that to me feels like a pricing power story. So to kind of harken back to consumers starting to exhaust itself, I think some of the catalysts for some of the deals and the action that you're seeing is because pricing power is starting to wane. And so scale in this environment is going to matter an awful lot going forward.
All right, Amanda Agati cut her teeth at Legg Mason. Now she's the CIO at PNC's asset management arm. Thanks so much for joining us. Great to get your take. Another quick check on futures after that CPI number. We're still looking at green arrows here, just about 1 or 2/10% on the S&P, and on the Qs, you see Russell 2000 up about 1/3 of 1%. So we're looking at gains even as bond yields rise a little bit, 3 or 4 basis points. Let's get a look at these individual stocks moving ahead of the opening bell. For that, we go over to Bloomberg's Jess Metten. Jess?
Well, happy CPI day, guys. The option market was pricing in a 1% move in either direction. But as you said, Matt, the futures kind of muted reaction right now. But when you look under the hood here, Micron Technology, one of the big movers this morning, if you look at that stock, up about 3%. So New Street Research actually reiterated a buy rating with $150 price target on this. Stock's actually up over 50% over the past 12 months, so outperforming its other components here. But really, this had to do with a lot of the AI and server type business. If you move over, though, look at some other other individual movers, though, have to point out Alphabet's Google getting pressured here, down about 1% in head of the opening bell here. A lot of this had to do, as y'all were mentioning earlier, when it comes to the Department of Justice potentially having any potential thing when it comes to breaking up the company, when it comes to its online search engine. Of course, this tried to do this a couple decades ago with Microsoft. Didn't work as well there, so it's probably why you don't see the stock moving even lower on this. But Alphabet stock's actually up about 18% year to date. And then moving over and looking at what's happening in the healthcare space for healthcare distributors, Cardinal Health here getting a bit of a pop here, up almost 6% ahead of the opening bell. If you look at its annual profit forecast, actually boosting that. But something to keep a close eye on is if it gaps up above its 200-day moving average. If you look at the A&R function right now, has 9 holds, 9 buys, and actually 1 sell rating on this. But those are some of the big movers ahead of the opening bell, guys.
Jess, we thank you so much. I know we'll talk to you later in the show. Looking forward to it. And coming up, we're going to talk about a major deal. Candy giant Mars is forking over $36 billion to buy Eggo and Pringles maker Kellanova. We're going to discuss the consolidation we're seeing in the food industry. Up next, Kellanova shares on the rise. This is Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. The world's biggest steel producer is sounding the alarm about a crisis in China with the potential to send shockwaves across the globe. The chairman of Baowu warned of a deeper industry downturn for the metal than the traumas seen in 2008, I should say, and 2015, with conditions in China proving to be, quote, longer, colder, and more difficult than expected. UBS, on the other hand, beat expectations in the second quarter after posting higher than expected profit thanks to investment banking revenue. The Swiss bank has also made progress in its integration of Credit Suisse, and CEO Sergio Armati doubled down on efforts to return capital to shareholders through a $1 billion share buyback this year. Victoria's Secret is poaching the top executive from Rihanna's lingerie brand to lead its turnaround. Hillary Super is replacing Martin Waters as CEO at the retailer, with CFO Tim Johnson assuming the role in the interim until September 9th. The lingerie maker has been struggling for years with competition and misconduct allegations. Sonali?
And we're keeping an eye on shares of Kellanova. We've been talking about it, one of the largest deals of the year. Mars is buying the maker of Pringles chips and Eggo waffles for $36 billion. Buying Kellanova will help diversify Mars's chocolatey product line away from cocoa, which has hit historically high prices this year. Mars has been diversifying into the snack business, and earlier this month, Kellanova actually raised its guidance for the full year. Let's discuss what's going on with Bloomberg Deals reporter Crystal C., who, of course, has been covering this story, but also realizing Kellanova actually recently spun out of Kellogg's, now merging with Mars. How is this a company that has changed hands like this? What does this make sense most in this industry for?
Yeah, so Kellanova is actually the RemainCo, and KW Kellogg is the spinoff. Anytime you have like a spin-off situation or any kind of a separation, actually both companies tend to become more vulnerable. Even though this is a really big company, it's like a 30 billion company. Today the premium is sitting at around 33% compared to the unaffected stock price 2 Fridays ago. I think it's really interesting because the tax, there was a tax implication when it comes to any spinoff, and that has reached its sunset. So it's a really good time for any buyer to come because the separation is done, the tax is out of the way, and there you go. This is a deal.
I feel like hanging over the M&A space, of course, is regulation concerns, antitrust concerns. What are we expecting when it comes to this deal, which has a pretty huge price tag? I believe this is the largest deal of the year.
It's the largest deal of the year so far. It's larger than the Capital One situation. So right now it is the top of the M&A league table. So congrats to all the banks and advisors that are on it. But like Sonali was saying, actually Mars has a lot of cocoa products. So it's mainly sugar, sweet confectionery products, whereas a lot of the Kellanova offerings tend to be savory snacks like Cheez-It, Pringles. So actually, all in all, it's actually quite a good combination. It's quite a complementary portfolio of products.
They also make Pop-Tarts, which is, I think, interesting because it comes after what is possibly the worst movie ever made.
Jerry Seinfeld. I love that movie.
You thought it was good?
Yeah, I loved it. Kitschy.
What movie is this?
The Pop-Tart movie.
Oh, I didn't know.
You didn't see it? Well, all right. I only saw a little bit. I couldn't get through the whole thing. But they get an international reach with this as well, right? Because Mars has been fairly restricted to U.S. sales.
So actually, Mars has some European operations as well. Mars actually has a pretty good global footprint. And when this when this deal was kind of became on the blog, when it became separate, it kind of put a sale flag on the company. One of the concerns is that if there's a U.S. buyer that approach Kellanova, it doesn't have the distribution or the expertise to sell the products globally like Kellanova does. Actually, Mars comes in being one of the most perfect natural buyer here because they actually know how to sell your Mars bar, your Twix, outside of the U.S.
Just wanting to comment here on Crystal's point here on the bankers here, because it did pop Goldman on the league tables, even higher up on the league tables, now firmly in the lead for M&A above JP Morgan from a 26% market share compared with JP Morgan's 23%. Lazard, also on the deal, came in with record revenue in the most recent quarter. So solid inking here of the deal's turnaround.
Well, like Crystal said, congratulations to the bankers. Crystal C., thank you so much. Appreciate your reporting this week. Now, coming up, we'll take a look at the companies making the most social buzz today in our Social Climber segment up next. This is Bloomberg. All right, it's time now for Social Climbers. The companies making waves this morning. And first up, Brinker International, the parent company of Chili's Bar and Grill and Maggiano's Little Italy, missing profit expectations and giving a downbeat outlook for the next year. The casual dining space, of course, has been hit by a decline in demand from cash-strapped patrons, and you're absolutely seeing that in shares today. Next up, FanDuel parent Flutter Entertainment reporting soaring sales in the second quarter. Remember, the company recently moved its stock listing to the NYSE from London and as such, benefiting from a surge in new U.S. customers. And finally, Donald Trump's appearance on X earlier this week, creating yet another headwind for his own competing social media platform. We're talking, of course, about Trump Media and Technology. Of course, this is the latest blow that's wiped out $3 billion in market value from the stock just in the last month. DJT, of course, struggling with mounting losses and stagnant user numbers. Of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal, Matt.
All right, let's get a quick check at what's going on in terms of the stock market futures. We're looking at gains of about 0.2% on S&P and NASDAQ futures. Don't forget, yesterday we had a massive rally. The NASDAQ was up, I think, 2.5% yesterday, and it's been the longest or the best 4-day stretch for the S&P. Here you can see the 2-year yield as well. Me and Sonali keeping a very close eye on 2-year yields. Up almost 5 basis points, although we did see a little bit of a dip into the number. The CPI number looked to relieve some market participants in terms of the coming cut. This is Bloomberg. All right, we got about 20 seconds until the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We are seeing green arrows here on futures right now. So S&P futures up 0.1%. Don't forget, this comes on the heels of a massive rally yesterday. NASDAQ was up 2.5%. Now you see futures up about 0.2%. Opening bell ringing at the New York Stock Exchange. Realty Income celebrating its 30th anniversary, the 30th anniversary of its listing. And you got Blacks at Microsoft looking to advance people of color within the company, recruit talent, retain talent, ringing the bell over at the NASDAQ. In terms of where the indexes are trading, just a few seconds into the start of the cash trade, let's get over to Katie Greifeld. She's got the details. Katie?
All right, 22 seconds into the U.S. trading day. As you said, it's a little bit quieter than what we were looking at yesterday. Of course, that massive rally following softer than expected PPI. Yesterday, we got bang in line CPI at 8:30 today. So Not too much of a reaction right now, but you can see the S&P 500 up by about 0.2%, a little bit more so if you take a look at big tech, up about 0.3%. Small caps in the lead right now, at least for right now. The Russell 2000 up about 0.4%. Let's take a look, though, at Victoria's Secret. Shares absolutely climbing right now on news that it hired the top executive from Rihanna's lingerie brand. Hillary Super will lead the turnaround plan for Victoria's Secret, which, of course, has struggled for years with added competition and a slowdown in demand. Super begins the new position next month, but, of course, traders not waiting. Shares currently up about 16%, Sonali.
Keeping an eye still here on Kellanova shares, up more than 7.3% this morning on the year's biggest deal. It's been talked about for some time, but this morning, Mars said it would agree to buy Kellanova for $36 billion, and here's the catch, in cash. And Kellanova makes, of course, snacks like Pringles, Eggo's waffles. Analysts have said a Mars-Kellanova tie-up wouldn't face major antitrust concerns, so the ARBs here have no reason to be all that concerned, if you listen to the analysts at least. Matt?
I feel like you're intentionally leaving out Pop-Tarts. Do you not like Pop-Tarts?
I don't. I'm more of a toaster strudel kind of girl myself.
All right, Sonali, thanks very much. Alphabet's Google. Bloomberg was the first to report that the U.S. Justice Department may soon attempt to break up Google after a landmark court ruling found the obvious. The company monopolized the online search market, as we all knew already. Let's discuss with Bloomberg Technology co-host Ed Ludlow out of San Francisco. And Ed, it's not, I guess, so important that they monopolize search or that they have a monopoly there. It's what they do with it, right? That's the problem.
Yeah, I think what we're learning through this reporting is that DOJ officials are looking at the entity as a whole, Alphabet, parent of Google, and saying, what action can we pursue? So the headline is that those DOJ officials and attorneys are considering a breakup bid, but there are many other options on the table. For what it's worth, Alphabet is down more modestly than it was in after hours when this story broke. I think we're down 0.8%, but so are some of the other mega caps. It's interesting, in particular, the divestment of the Android operating system. So we know that the concern about Google is that when it negotiates with a device maker, it contractually requires them to have preferable placement of, say, the Chrome application or Gmail application on a phone that has Android OS. So what about divesting Android OS? The other battleground is data. Either that Google is precluded from accessing data of the websites that it has access to through search, or its competitors get access to its data. So read the story. There's a number of options on the table here. A very thin sell-side reaction, and so it's hard to gauge the concern.
Yeah, well, that's what I wanted to go to, and I'm glad you brought up the pretty muted reaction right now. I mean, Alphabet shares currently down about, 0.7%. I mean, what to make of that? That the concern here isn't that great, that basically traders aren't seeing this as a very serious possibility?
What's that great Bloomberg expression at the moment? Context changes everything. Washington hasn't tried to do this for 20 years when it looked at Microsoft and wasn't really able to take that action. And so that's why the detail of the story is important. You know, a breakup bid of this size, factor in the political will needed to do it, the potential change of White House in November, particular focus on J.D. Vance, and the continuity of policy around antitrust. But it's just really difficult to do because how ingrained search and Android OS is in devices and people's habits around the world. But the sell side is sanguine. I think I've seen one note from Dan Ives, who's kind of shrugged it off. He's pretty bullish on tech, generally speaking. Right, so let's see how they act.
Yeah, and obviously after September, there's going to be a lot of discussion that will re-amp up about this exact matter. Bloomberg's Ed Ludlow, we thank you so very much. We know we're going to cover it much more on Bloomberg Technology at 11 o'clock. We're going to broaden out the conversation now about the markets with Lazard chief market strategist Ron Temple, because, of course, elsewhere, in addition to all of this news about big tech and about deals, we also had CPI this morning. The data has still been driving the narrative. We have retail sales tomorrow. We have jobless claims. So you take it all together, and where are you still looking for the most clues on the path forward to that next rate cut?
Well, I think the evidence is definitely in that inflation is largely back under control. If you look at the CPI over the last 3 months, at a headline level, it's annualizing at 0.4%. On a core basis, 1.6%. Again, 3 months is kind of short. But if we extrapolate back, you see a clear trend lower in inflation. And then the big debate is this because the economy is weakening too rapidly? You just mentioned retail sales tomorrow. On Friday, we'll get the preliminary Michigan sentiment, although that one's a little questionable because it tends to inversely relate purely to inflation. And then really the next data points are early September when we get the jobs data and JOLTS. So I think the evidence to me is the economy is still strong, inflation is decelerating, and full steam ahead for the first rate cut on September 18th. But I don't think anyone should hold their breath for 50 basis points.
As the consumer weakens, do you consider that gradual? I mean, they're not buying the big ticket items, not making holiday bookings. I even have been reading Bloomberg Intelligence research that marijuana buyers are looking for smaller ticket purchases. They're going down market a little bit. So clearly, wallets are tight.
Those were really the big spenders, Matt.
No. The point is, I mean,
that might go back to your Pop-Tart conversation.
Right.
Yeah. Anyway, I don't think we should extrapolate from cannabis, but I do think there are signs of the consumer basically seeing more fragility. I was encouraged last week. The New York Fed put out their quarterly household debt survey. The prior quarter, I was pretty worried because we saw significant increases in 90-plus day delinquencies on mortgages, on auto loans, credit cards. This quarter, it was stable. So 1.83% serious delinquencies, same as last quarter. Consumer debt went up very little in the quarter. So this says to me, yes, there are again signs of some moderation. And I'm always careful to say, by the way, let's remember the economy started from a very strong position. So it's a deceleration of a strong economy. It's not a weak economy.
And I mean, if you take a look at the sector level, I mean, I hear what you're saying, and we're talking about the weakening consumer. And I mean, for some people, that would scream staples. I mean, invest in the companies where people need to spend money. But then you take a look at the sector level going back a month, 3 months, year to date, and that's kind of been mid-pack. It really feels like it's just been tech that's dominated up until, the past month or so. I mean, how do you put that together into a portfolio view?
Yeah, so I think what's really been interesting, again, is every day I tend to look and say, okay, what percentage of the year-to-date gain has been the top 10 stocks, top 20? It's still nearly 70% 10 stocks year-to-date. It's 80% from the top 20. But what's really interesting, if you look at the earnings trajectory and what the market is expecting as we move toward year-end, is the gap between the big 6 tech companies and the rest of the market narrows substantially. So I believe this quarter, if you look at the top 6 companies, it's around 38% year-on-year earnings growth. Rest of the market, 3%. And so by the time you get to the fourth quarter, those numbers go to 18 and 9. So I think that's what's going to be interesting is this broadening out within the market, not necessarily to staples. It might not exclude staples, but I think you're going to see more beneficiaries of this spending on tech as we move into next year. We're also going to see the beneficiaries of lower interest rates. I mean, if you think about it, small cap stocks are one of the biggest beneficiaries. The Russell 2000 has twice the debt to cap of the S&P 500, and 45% of that debt is floating rate versus only 10% for the S&P 500. So I think you're going to see some benefits there, and actually might be one of the better opportunities in the market right now.
One of the moves this morning that I was most interested in was the way the yield curve moved. There was a further steepening of the yield curve, and I've got to say, this week, a lot of investors aren't watching CPI as much as maybe they're watching jobless claims, which in a prior world, that wasn't the case very recently. Are you worried about a landing that could be a little harder than what most people are prepared for right now?
I mean, we always have to contemplate the range of outcomes that could occur, but I'm quite confident that we are not going to have a hard landing. Again, this is an economy decelerating from strength to less strength, but I look at the yield curve right now, a 10-year yield at 385 this morning. To me, that's too low. I think the 10-year yield should probably be between 4 and 4.5%, and so that steepening makes sense. I think you're going to get the short end of the curve is going to come down. I think the market, by the way, is expecting too much at that end of the curve. And I think the market is pricing in too much in terms of how low Fed funds will go in the easing cycle. So if you look at Fed funds futures, use WIRP on your Bloomberg terminal, you can see by July of next year, the markets are saying 200 basis points of rate cuts. I don't see that. And I don't see 100 basis points by year end. I think basically the market's overreacting to 1 month of bad data from the jobs report.
And of course, that steepening trade, it's been breaking hearts for like a year. I feel like people have been trying to make it work to little success. But Ron, we're just getting started. You're sticking with us. That, of course, is Lazard Chief Market Strategist Ron Temple. Meanwhile, let's take a check on these markets. Of course, a couple minutes into the cash trade, you can see the S&P 500. Small gains. We're talking about 0.1% after that inline CPI print. Of course, all the big moves were yesterday after PPI. We're going to continue to keep an eye on market markets next. This is Bloomberg. All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Deutsche Bank says that Starbucks is now a buy, thanks to news, of course, that the coffee chain has tapped Chipotle CEO Brian Nichols to take the reins. Deutsche Bank says that this is a home run hire for Starbucks. Deutsche Bank's just one of the handful of banks upgrading the stock in the wake of that announcement. Next up, Argus Research says stop buying Hershey. The maker of Reese's Pieces slashing sales and earnings outlook for the year as shoppers really cut back on purchases of higher-priced chocolates and candies. Goldman rating the company a sell earlier this week as well. And finally, Cantor Fitzgerald telling investors to turn up the sound on SoundHound, recommending the stock as a buy and raising its price target. The company, of course, announced robust second quarter results along with the acquisition of an AI software company. The analyst over at Cantor says that the deal could be, quote, transformative, Matt.
All right, interesting stuff. We are back now with Lazard Chief Market Strategist Ron Temple, and I wonder what your take is on stocks. You know, it seems like everything we were freaked out about the last few weeks has passed us, right? The carry trade has been largely unwound, or maybe doesn't matter as much as we thought. The earnings are really solid. Inflation is coming down. The Fed looks like it's on track for one rate cut, but not, you know, an emergency rate cut of 75 basis points. Can we head back to 56, 57, 5,800 on the S&P at year end?
I think we can. I'm optimistic on the market more broadly. I do think, again, the dynamics are going to shift within the market away from being largely driven by 6 stocks to a broader base as earnings accelerate for the rest of the market. But, you know, I don't want to go too far in terms of valuation. S&P 500 is at 21.7 times forward earnings as we speak. That's not cheap.
Is it priced to perfection? I mean, do we risk a drop if we disappoint on earnings?
No, I think there definitely is risk in certain individual stocks, as there always is. But when I look at equal weighted S&P, it's materially cheaper. If I look at other indices outside of the U.S., I think there's some real opportunities there. So I'm optimistic we still have upside, again, based largely on my scenario, the base case scenario of no recession, easing of interest rates. Importantly, when the Fed does ease, I don't think we're going to get 200 basis points of easing. You know, that would be the maximum I think we get out of the Fed. So maybe discount rates are a bit of an issue. Maybe we get 100 to 150 basis points of easing in the next year. So a little less optimistic on the Fed front, but that's because I think they're easing because of lower inflation, not economic weakness.
I also think one really important aspect of this is that inflation isn't a monolith. And if you looked at the data this morning, it was housing, it was insurance, it was kind of these important areas that people really need that would potentially, and this is according to Bloomberg Intelligence's Stuart Paul, crowd out the discretionary spending that you would see from the consumer. How much do you buy that theory and start to worry about stagflation under the surface?
Well, I'm glad you brought this up because when you look at the moving parts, all of the inflation this month, so core inflation 16.5 basis points, 23 of that was housing, right? So core goods went further into deflation. So it's really interesting. If you go back through the history of this inflation cycle globally, it really is largely a story of the pandemic, right? We had the surge in demand for goods. At the same time, you had supply shortfalls because of semiconductor shortages, shipping disruptions, et cetera. You had a big increase in goods prices. That's unwinding now. And so what's really driving inflation is housing and, frankly, auto insurance. If you look at auto insurance prices up 18.5% year over year in July, that contributed over 4 basis points of the 16 basis points, of course.
Mine is off the hook. I mean, it's like ridiculous.
It is consistent. And by the way, the range of factors, if, you know, minor repairs that used to cost you $100, there's so many electronics embedded in cars now. You know, getting a new mirror on the side door could cost you $800 to $1,000 because their camera in the mirror is so expensive. And so there's partly that, but then there's also this concept of social inflation, which if you want to nerd out with some insurance analysts, go for it. But bottom line is there's more litigation, and juries are seeming to be more sympathetic to the litigants.
This is so my home turf, Ron, I've got to say. This is the nerd in me.
How's your auto insurance? You just got into a new car?
Not great.
No.
But that's got a long history to it. Resume.
All right, let's go back to earnings because we are in earnings earnings season, and I don't know, you think about expectations, especially, you think about the broadening out that everyone told us was going to happen in earnings. Hasn't necessarily happened, and it feels like just overall this has kind of been a mediocre reporting season. And I mean, you translate that into what we're seeing in the macroeconomic picture with expected Fed rate cuts beginning in September. I mean, what does that translate to going forward through the end of the year?
I mean, you're right that it's been mediocre relative to the last 2 quarters where you had bigger beats on average relative to expectations. But let's just keep in mind, earnings this quarter are still likely to grow 11% on 5% revenue growth. That's good. I mean, on average over time, I think we should be expecting more like 8 to 9% earnings growth out of the S&P 500. So again, not so bad. The composition is the bigger issue that we've already talked about. And again, that's where I get optimistic about the ability of the market to rally from here, is when you have more companies delivering better earnings growth, that should lead to a healthier market. It's really interesting, by the way, back to the 80% of the rally year to date from 20 stocks. If you look in European markets and other non-US markets, it's a much healthier rally that we've seen. For example, looking in Europe, you've got banks, you've got tech, you've got healthcare. In the US, it's tech, right?
Yeah.
And so I'm looking forward to seeing that transition as we move toward year end, and I think that's a positive sign for the market in general. And I don't want to miss this, by the way. I do think people should look beyond the U.S. because the big sell-off in the last 2 weeks, Japan is the glaring sell-off. And a lot of the clients I talk to have been saying for the last year, every strategist is telling me own Japan, but when you ask them, well, do you own Japan? The answer is no. Well, if you've been waiting for your opportunity, now's a good time to do your homework on Japan as well.
Ron, great having you in. I'm going to try and get you back in here when we get the non-farm payrolls number, or before the Fed, let's say, in September. Ron Temple, their chief market strategist from Lazard. Coming up, some investors say credit investors should be listening more closely to what the VIX is saying. We'll explore in our Wall Street Beat next. This is Bloomberg.
The bond market is definitely pricing a higher risk of a hard landing. I mean, that's what the yield curve's telling you. That's what the 2-year yield versus the Fed funds is telling you. As an equity person, you should pay attention. I mean, the bond market has probably a better, look at, okay, what is the risk here? The bond market's not saying recession, to be clear. It's saying the risk of a recession has gone up in the last 2 months, which makes sense.
That was Mike Wilson, Morgan Stanley chief U.S. equity strategist, joining us yesterday on a hard landing signal that might be coming out of the bond market. And for today's Wall Street Beat, we're taking a look at what bonds and equities are saying about the likelihood of a U.S. recession. Here to help us more is Bloomberg's Olivia Raimonde, who wrote this story, and it was interesting. Just a day ago, we were talking about Boaz Weinstein and his campaign against closed-end funds, but really he benefits in times like this, of volatile times, volatile stock and bond markets. What is he saying? What are other people saying about the mixed signals here being seen between the credit spreads and where they are right now and what the VIX has been doing?
Yeah, absolutely. Boaz put out a really interesting tweet last week during the market volatility that showed the correlation between VIX moves and moves in credit spreads. And essentially, he said that we've never seen a VIX this high and credit spreads widen out so little. So he said one or both must be wrong. The question is, what's the answer to that? And Boaz says that credit spreads are underpricing in the risk of a recession. We've seen weak labor data, weak housing data, weak manufacturing data. And yes, spreads widened out last week, but not nearly as much as the VIX did. And now they've come back down, and some investors say that spreads will widen again, but there are others that are firmly in the soft landing camp.
I mean, I thought that was an interesting tweet as well, because how much can you trust the VIX? I mean, I know we got to, 40 on the VIX last
64.
week?
65 almost,
well, the intraday, I'm just looking at, the closing. I guess that doesn't quite matter. But now we're back at 17. The point being, we went up and now we're down. So, I mean, is the VIX the true signal here, or is it credit spreads?
Well, to be clear, they both went up and they both went back down. So it was, the magnitude of the move. I think what Boaz and TCW as well is trying to say is that even though the VIX probably overshot and there was a lot of technical factors that had to play into there, the move itself still reflected real concern about the recession going forward, whereas the widening that we saw in credit spreads and just where we see them sit now and even last week compared to historical averages is way too low and not pricing in nearly as much recession risk as BOAS and TCW and other funds think should be priced in.
All right, Olivia, great story. Thanks so much for joining us. We're going to keep an eye on both of those things, the VIX and credit spreads. I want to get to the trading diary right now, what you need to be watching for the rest of the week. Tomorrow, we get retail sales data, plus, of course, we get earnings from Walmart tomorrow, as well as Deere. On Friday, U.S. housing starts are released, and the University of Michigan consumer sentiment data, although Ron Temple doubts the importance of that. We're also going to hear from Chicago Fed President Austin Goolsbee this afternoon. You've had some Fed speakers pushing back against the necessity of a rate cut in September. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, core U.S. inflation eases for a fourth month, keeping the Fed on track for a rate cut in September.
As investors digest the inflation data, we'll look ahead to retail sales. We speak with the CEO of SharkNinja, a consumer goods company that's accelerating growth.
And it's the biggest deal of the year. Mars scoops up snack maker Kellanova for $36 billion. We're going to talk about all of that and more, but let's take a check of where we are on the markets 30 minutes after markets opened. You can see taking a dip lower right now. The S&P 500 actually falling in the red, down 0.2%, even more so on big tech, of course, down 0.5%. We had that big rally after softer than expected PPI yesterday. We got inline CPI today, and now you're seeing some of that enthusiasm come out. The bond market, a little bit of a rally on our hand. 10-year yields currently down about 2 basis points, Sonali.
Absolutely fascinating. You have about half the sectors in the red. This morning, most sectors were in the green. A bit of a rotation also. Energy was down, now up. Interesting trading day. We're also going to get a look at stocks moving this hour with Bloomberg's Jess Menton joining us here on set. What are you looking at?
So many different movers today, but of course the big thing was the biggest deal of the year that y'all have been talking about all morning. So when you are talking about Kellanova, the ticker symbol's K on this. This is actually the top performing stock in the S&P 500 right now. So if you look over at this, up more than 7%. So on pace for its best day, not since that long ago, August 5th, but we did have some reporting from the Wall Street Journal where we did have a heads up that something like this could be happening, though. If you look at the S&P 500's food and beverage companies, though, it's actually performing flat as a group today. But on a year-to-date basis, they're both up actually about 14%. So that's actually in line where the S&P 500 is year-to-date. Normally, those companies have been underperforming the broader S&P 500. But another one I'm looking at is in the retail space. Of course, Victoria's Secret. Wanted to point this out. Seeing a huge pop here. So up almost 17%. So on pace for its best day since August of 2021. So, of course, this retailer, as we know, has struggled. It's actually down 15% still year to date when you're looking at this. But it actually had a preliminary profit beat for the second quarter, also naming a new CEO, Hillary Super, who's actually the chief executive. And you're actually looking at Rihanna's Savage X Fenty line.
I feel like Victoria's Secret is really, there was a time when I would go to every Victoria's Secret show. As a journalist,
right?
Oh, I'm shocked.
Reporting
I'm shocked
for
necessary disclaimer.
Reporting for Bloomberg. No,
say.
I would bring a camera crew and everything. Like we would do something on it because it was such a hot stock. It was such a hot industry, and they have since. I don't even know when the show is anymore.
Right. That's
Didn't
been a big thing. They canceled it, but then I think they're trying to bring it back.
Yeah, well, it was popular. It is interesting, though, that that's one of the themes that has emerged this week.
Right.
Of course, management changes. I feel like it says a lot about the environment that we're in, that management really matters.
Yeah.
Traders, investors, shareholders, super focused on the C-suite right now.
They definitely are, and especially when it comes to not even just an industry perspective, but company by company perspective. And then lastly, wanted to bring up what's going on in the sports betting type scene. I'm sure, I don't know, Matt, if you get into that kind of space or not.
I only lose.
But you only lose Flutter. So this is actually the FanDuel parent here. It's actually up almost 10%, on pace for its best day since January 18th of earlier this year. So did report second quarter results for sales and profit, actually beat those expectations, also raising its full year guidance here. But if you look over at DraftKings, it's actually interesting because they both said they're not going to add a surge charge when it comes to high tax states. So you're seeing seeing DraftKings also getting a pop this morning as well on the back of that.
Football season just starting, too.
Yeah.
Just in time, right?
Coming up.
Exactly.
All right, Jess, thanks very much. Jess Menton there. She covers stocks for us on the BN side. Let's discuss these markets now with Edward Jones, Senior Investment Strategist, Mona Mahajan. And Mona, we did see, initially stocks rise after the CPI number. It came in bang in line with expectations. But we now see stocks falling a little bit, and there's been some debate. I think, Sonali, you were talking about earlier, is this a soft 0.2% or a hard 0.2%? So what's your take, Mona?
Yeah, look, I think some of the good news from inflation this week got priced in yesterday with a positive PPI result as well. We saw the NASDAQ up almost 2% on the day. And if you look more broadly over the last week or so, both the S&P and NASDAQ have rallied about 5%. So, of course, we were coming in with better expectations for these inflation prints, and we got exactly that. Now, to your point, today's inflation number will take the 2.9% headline CPI. I think it's great to see a two-handle there. But we did see still some stickier shelter and rent inflation. We'd still like to see that part of the equation moderate over time. And we do think, the lag from what we're seeing in real-time data will show up in the months ahead. We're also watching wage growth carefully, as that is a huge factor in services inflation. We'd like to see services overall continue to moderate. But we think we're moving in the right direction when you look at the Fed's dual mandate inflation and PCE inflation, certainly below their 2024 forecast. And of course, the other side of the dual mandate is what everyone's watching even more closely. Will that labor market hold in? We've seen some softness recently, but thus far on track for a good September 18th FOMC meeting as well.
All those people out there that were banking on a 50 basis point cut, you do see expectations truly changing when you look at Fed swaps right now. The reality of the situation, if the Fed cuts rates 25 or 50 basis points, what happens to shelter, given that housing prices tend to rise when you see rates come down?
Yes, it's a great point. First of all, we think if they do a 50 basis point cut, it will probably spark an unnecessary concern in markets that they know something that we don't know, or something's happening in the economy. So our base case remains for a 25 basis point rate cut in September. To your point, as mortgage rates start to move lower, there is a case to be made that we'll start seeing some movement in the housing market finally. Those folks that had not been willing to put their homes up for sale might start doing so because they can lock in better mortgages on a new purchase. And that opening up of the market, adding supply to the market, may actually have the impact over time of bringing prices down, or at least moderating to some extent. So it is an interesting conundrum, but I think net, what we will see with mortgage rates potentially moving lower is more housing activity, and that will create some halo effects around industries across the housing space, and that's what we want to see. So I think net, it will be a positive for the housing market to see those mortgage rates come in a bit.
Well, we were having that conversation yesterday, too. I mean, on the other side of lower mortgage rates, what are you going to see in terms of pent-up demand, and what will that ultimately mean for housing prices? But I actually want to bring up this note that actually just came out from Bank of America. We've been talking so much about this rotation trade in terms of size of company, big to small, which is kind of petered out. But they actually say that you should fade small, mid, and mega cap stocks and go straight into the S&P 500 equal weight, basically take out that as a factor. How are you thinking about what the size tiers mean when it comes to this market?
Yeah, it's an interesting conundrum because, of course, we still think within large cap, and exactly to your point on the equal weight, we could get a more diversified set of leadership going forward. So we certainly think if the theme for the last 6 months, the last year and a half really has been narrow leadership is winning, and we've seen that with the mega cap tech space. We think the theme as the Fed starts cutting rates and as we head to the next 12 to 18 months will certainly be a broadening in market leadership. And so that equal weight S&P and the S&P 500 broadly makes a lot of sense to us. It's about 50% growth parts of market. Now it's about 50% cyclical and value parts of market. And so you really do get that broad exposure. And to your point on what part of the cap space to play in, we still kind of remain favorable on large and mid. Keep in mind, small cap, while it does have some, it does tend to perform well in an early cyclical part of the market, early cycle part of the market. It does also have generally that space is more leveraged, and it tends to have more negative earners or zombie companies. So we remain cautious there as a long-term investor. We'd still say We think there's opportunities in the mid-cap space and certainly in the large-cap space. So those are two parts of the market that we would start to look at more carefully in that broadening theme, too.
What do you expect from the Fed here? As Sonali points out, WIRP is above 25, right? So markets are pricing in more than one rate cut, not quite two yet. But at the same time, you've got an election coming up in November. This is a Fed that isn't just extremely, cautious and conservative, but also really doesn't want to be seen as political. Wouldn't it be a step too far if they cut 50 basis points right before an election?
Yeah, I think right now the data doesn't seem to warrant a 50 basis point rate cut. There was a lot of concern when that labor market report came out last Friday that we are heading into some imminent recession. But since then, we've gotten a set of economic data points that have actually kind of stabilized that market and at least provided a bit of a optimism there. We got an ISM services that was above expectations. We, of course, got jobless claims that were below expectations, and we're getting this nice set of inflation data. So, in our view, we think in September, certainly it warrants them starting the rate cutting cycle. I think both sides of their dual mandate are calling for that. But we think 25 basis points. If you look historically, the Fed actually has moved in election years and around election day, and it hasn't really created any sort of market implications other than what's happening in the broader economic backdrop. So we do think they could move in September. Our original thought was that they may do a quarterly cadence just to keep it a little bit more systematic, maybe September and then December. But if the data warrants them to continue at a faster pace, we certainly think September, November, and December may be on the table this year. So 2 to 3 rate cuts in the back half of the year remain our base case, regardless of what's happening in the political sphere.
Mona, we're talking so much about what to really lean into in the stock market. People excited about a broadening, but some sectors still really iffy. Consumers is what I want to talk about with you, given we have retail sales data tomorrow, and this idea that we've been talking about here, that if people are spending more still when it comes to shelter and insurance, if certain parts of inflation remain sticky, how much does that crowd out other forms of spending here that could really crimp the consumer sector moving forward?
Yeah, we've certainly seen a little bit of downward pressure on the consumer. And, we've talked about how a lot of, especially the low-end consumer, has worked down that post-pandemic savings. We are now seeing credit card absolute levels move higher, but of course, delinquencies start to tick up in areas like credit cards and auto delinquencies as well. But keep in mind, still the majority of consumption comes from this mid to higher end consumer. It's about 80% of the consumption base. And that consumer has seen a nice appreciation in their net worth from the stock market expanding, and even in some cases from their home prices moving higher in the last 18 months or so. And so that part of the market continues to remain intact. They continue to spend still, especially more on services, but still the good side of the equation is holding up pretty well. And so generally speaking, while we do see the consumer kind of coming off, normalizing from an outsized level of strength after the pandemic period, we don't see a collapse. So a cooling, not a collapsing in consumption. Similarly, with the labor market, those trends are intact as well. And we'd say broadly, if the labor market holds up, consumers tend to spend most when they feel comfortable with their jobs and they feel comfortable with the prospects of the job market overall. And so if that environment holds up okay, we think consumption holds up okay. But just keep in mind, it's the mid and higher end consumer that's really driving most of consumption here in the U.S.
Well, we'll get a great look at maybe the mid and lower tier when we get Walmart earnings tomorrow. Mona, thanks so much for joining us. Great to get your take. Edward Jones, Senior Investment Strategist, Mona Mahajan. Coming up, Elliott pushes for sweeping changes at Southwest as it tries to save the struggling airline. We'll give you the details on that proposal next. This is Bloomberg. All right, let's get to high interest to look at what's making headlines around the world. Norway's $1.7 trillion sovereign wealth fund returned $138 billion in the first half thanks to a surge in tech stocks, although those returns were restrained by weak performance in bonds, real estate, and renewable energy infrastructure. The investment arm of Norges Bank also increasing its stake in big oil while trimming its stake in Meta, ASML, and Novo Nordisk. Germany's public prosecutor has issued an arrest warrant for a Ukrainian diving instructor who is suspected of being one of the perpetrators of the 2022 attack on Nord Stream 2's gas pipelines, according to local German newspaper Süddeutsche Zeitung. The warrant was activated in Poland 2 months ago, but authorities there have not yet arrested the instructor. And Americans are refinancing their mortgages more than they have since the early days of the pandemic. The Mortgage Bankers Association refinancing index jumped to 2-year highs last week. The surge comes as borrowing costs drift lower, even as the Fed leaves its key rate unchanged for now. But why don't they just wait? They should just wait, right?
Perhaps. We're going to switch gears here because there is one fund in particular that you are hearing a lot about this week. That is Elliott. And remember, from the shakeups at Starbucks to the wins that it's making on the board of Southwest, Elliott is actually by far, and it usually is, but this is just how much by far it is leading the activist universe this year. It has 11 campaigns in the first half, according to an analysis by Lazard, the investment bank. And the second most campaigns you've seen is 6 campaigns by Oasis. So it's a significant lead over there by Elliott. Elliott was also the only activist to have multiple campaigns in every major jurisdiction around the world, 6 being in North America alone. Boy, guys, would I love to get my paws on Elliott returns this year when you saw Starbucks' surge alone yesterday and the wins that they have been trying to ink, Katie.
Well, speaking of Elliott, they're trying to land some board seats over at Southwest Airlines, the activist firm nominating 10 candidates to the board, of course, in efforts to turn around the struggling airline. Here with more, I'm pleased to say we have Bloomberg Global Aviation reporter Benedict Kammel. And in addition to trying to oust the CEO, of course, what other changes does Elliott think that Southwest should put in place here?
Well, you mentioned it there. You know, they came out yesterday and said we'd like to nominate 10 new board members. This is a board composed of 15 people, so a pretty comprehensive switch that they're looking for here. And really, it comes off the back of the company, the fund saying this is an airline that is stubbornly resisting change. They should really upgrade their strategy, and that's not happening fast enough. And therefore, they came out yesterday with a statement. And interestingly, it came out on the same day that they had that win over at Starbucks, where they did manage to oust the CEO. So if you look at those two campaigns sort of split screen, you can see, okay, they succeeded on the Starbucks side. How far will they get it at Southwest? The company came out today, the airline, saying, well, we'd like to stick with our strategy for now. We are willing to listen, but on our terms, and replacing 10 board members doesn't seem to be what they want to do at this point.
Benny, take us up to the 35,000-foot view of what's going on in the airline industry, because last year we were just talking about the fact that they couldn't get enough planes, right? And the wait lists or the order books are just so monstrous, you can't even believe it. On the other hand, it looks like now there's just too much capacity, at least in terms of American airlines. So what's the deal?
Yeah, it's not just the American airlines, it's really across the globe. You know, the much talked about revenge travel, that is sort of coming off its sugar high. People they have consumed most of their savings. They are a little bit more frugal when it comes to their expenses. The whole notion of spending on experience, that's sort of come down a little bit, and we've seen it really across the board. It's not just the airlines. We had pretty glum numbers from the likes of Airbnb and a couple of other sort of hospitality companies. You talk to low-cost over here like Ryanair. It's really everywhere that people, they're not stopping traveling altogether, but they're not quite as willing to splurge as they did previously. And in that context, if you're trying to manage a turnaround like Southwest is, that's difficult. It's always hard to manage a turnaround in a downturn, and so that's an additional headwind for them.
You have a lot of headwinds here, as Matt was talking about, in the industry alone. Southwest stock this year is down more than 12%. Management wants one thing, Elliott wants another. And of course, plans to really consolidate in this industry have not gone well. How much leverage does Southwest have against a major activist investor?
Well, that's a good question. It's unclear at this point how it'll sort of play out. At this point, the two sides seem to have sort of locked horns. Southwest did say, yes, we're willing to listen. They said we put out an offer to meet in early September, and we wanted to sort of bring some ideas to the table. And then before we could even engage with you guys, being Elliott, you came out with this rather aggressive foray saying we want 10 people replaced on the board. So at this point, it looks like, especially given the win that they had yesterday with Starbucks, that Elliott sort of has the wind in the sails, and it's going to be an increasingly hard battle for Southwest to get this over the line. At the moment, investors seem to think, yes, they're making some changes. Let's see how that plays out. So maybe the pressure isn't quite as high as it was on the Starbucks side, but one way or the other, something will have to happen.
Benny, thanks so much. Bloomberg's Benedict Campbell covers the airlines and the plane makers for us as well from Berlin. Still ahead, bottoms up for Tilray, the cannabis company buying some brew brands from Molson Coors. We'll give you the details next in today's Social Climbers. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Google's Fitbit partnering with Peloton in a deal that would let some users access fitness content. Fitbit premium members would have access to Pilates, boxing, and spin classes. Peloton members, meanwhile, would receive offers on Google Pixel watches and Fitbit devices. Now, this partnership comes at a time when Peloton trying to outrun sagging demand for its stationary bikes and its treadmills. Next up, Donald Trump's appearance on X earlier this week created yet another headwind for his own competing social media platform, Trump Media and Technology Group. It's the latest blow that's wiped out $3 billion in market value from the stock in the last month. DJT is struggling with mounting losses and stagnant user numbers. And finally, a match made in Matt Miller's heaven. Tilray agreeing to buy 4 craft breweries from Molson Coors as it tries to diversify beyond cannabis products. It's, of course, Tilray's latest push into craft beer. Remember, the company bought 8 beer and beverage brands from Anheuser-Busch last year. Matt, this is exciting. You have a big interview coming up.
Yeah, I'm going to interview the CEO, Irwin Simon, in just about 2 hours' time.
This is a deal, that 2.8% is added to the Tilray stock from this deal. Investors like it.
Yeah, absolutely. Well, listen, this is a company that, obviously started in cannabis research, medical marijuana, then recreational, but only in Canada. So they don't sell weed here in the U.S. Actually, they do in Europe as well, but nothing here in the U.S. And they've diversified into craft beers so much that I think they're the 5th, maybe now 4th biggest craft brewer in America. So is it like mixed cannabis beer situation? Well, no. There's no weed in the beer. But that's the next move, isn't it? It may be the next step.
THC-infused
Exactly.
beer. I feel like that's out there.
Yeah,
right?
well, there are THC-infused beverages, but I'm not sure how strong the public acceptance has been of them yet. It's hard to dose, right? How many do you drink? How do you know how high you are?
Anyway, ask him about it.
We'll talk to the CEO of Tilray about that. Catch my interview with Irwin Simon coming up at 12:20 p.m. Eastern. We're going to talk about SharkNinja next, which makes a product that you may have and not even know about it. Stay with us for Mark Barrocas. This is Bloomberg.
We are faced with a challenging U.S. environment, just like many other consumer-facing companies.
We do see some pressure on the consumer's overall financials.
What we see happening more than anything is the lower income consumers are a little bit stressed.
Consumers have the income they have, and they're making choices in the everyday basket.
The U.S. economy is a little bit stronger than people are giving it credit for, and the consumer will come back as the economy continues to strengthen.
Number of CEOs and CFOs there on Bloomberg Television talking about the current state of the consumer. It's a debate. We'll get another read tomorrow morning with retail sales data. One consumer name that's having a very strong year is SharkNinja. The stock continues to climb, up nearly 80% year to date, as consumers are still buying their kitchen appliances, vacuum cleaners, smoothie blenders, and apparently hair care products too. Joining us now is the CEO of SharkNinja, Mark Barrocas. Mark, it's fascinating how many products you have and how successful these products, become so quickly. How do you avoid the pitfalls of a weakening consumer and high rates?
Well, thanks for having me. And as you said, we're in 34 different product categories, our Shark and Ninja brands. We sell them in 27 different countries. I mean, we're the largest vacuum brand in the United States. We're the largest cooking appliance brand. We're the fastest growing outdoor cooking brand. We're the fastest growing hair tools company. And the consumer is under a lot of stress and pressure, but I think our playbook of market-leading performance, high quality, and extraordinary value has been a recipe that's worked very well for today's consumer environment.
On the other hand, you do have a brand that has just gone viral on social media. We were showing some of the videos a little earlier. And I wonder what it means for you ultimately in terms of your own costs. I mean, is it cheaper to market on TikTok? Do you hire influencers to help do that? Or is it harder now to market on more traditional streams?
Well, look, everything starts with these proprietary consumer insights. We're trying to identify known or unknown consumer problems, and we're trying to turn those problems into disruptive innovation that solves consumer problems. And we market that through lots of different ways. I mean, if you go back in our company's history 15 years ago, that was through long-form infomercials. And then it went to TV commercials, and then it went to Facebook. And then it started really with one 5-star review at a time. And today it's on social media. And social media is one of the largest forms of advertising for us. But what's amazing is that if you think about a product like our Ninja Creamy that has over 1 billion impressions on social media, last month, 99.6% of those impressions were generated having nothing to do with SharkNinja. It was just organic user-generated content that bought our products, had a great experience in the home, and went and told lots of their friends about it.
Well, let's talk about the different product categories, because you brought up the Creamy, for example. You're in all these different lines. And I want to specifically talk about your cleaning category, because I was reading through your earnings report. I saw that cleaning grew 20%. You haven't seen that kind of performance since COVID, which makes me a little bit nervous. I mean, where is that coming from, do you think?
Well, to start off with, I mean, we grew our revenue 38% in the quarter, and the growth was really broad-based. I mean, our international business grew over 45%. Our domestic business grew over 30%. And as you said, cleaning, our largest category, which makes up nearly 40% of our business, grew 20% year on year. And that's really coming from 3 things. We entered into new categories in cleaning. Our products like the Shark Carpet Expert and the Shark Stain Striker are doing great in the carpet cleaning segment. We've grown in SKU productivity. We've refreshed a lot of our legacy SKUs with new technology and improved productivity of those SKUs. And we've launched a lot of new products in our existing categories. We just launched a new upright vacuum called the Shark Power Detect. That is a new top-of-the-line technology that we've done in that category. So it's really through a combination of things, and you put all of that together, and it's driven the 20% growth that you're talking about.
Are there price points you like to hit? I mean, do you find a certain entry point that makes it easier for consumers to buy, or do you use, for example, buy now, pay later programs to make it easier?
Well, look, we're not the highest priced products in the market. We're not the lowest price. But I think when you look at SharkNinja, we deliver affordable, accessible innovation. We move the opening price consumer up into our brands, but we're also the brand of choice for premium consumers. We sell everyone from Walmart all the way up to Sephora and Ulta and everyone in between. So there are accessible price points for the consumer to get into, like, for example, our $59 Ninja Blast cordless blender. And that runs all the way up to what we just launched was our Ninja Cafe Luxe, which is a coffee espresso machine at $499 that's doing really well right now. So it's across a really broad breadth of price points.
Let's talk a little bit about the future here, because you spun off a little over a year ago. You were really starting trading around $30 around that time. Your stock has nearly tripled since you started as a standalone company. That means you also have currency for a whole lot of things, Mark. Do you look at acquisition as a way to expand here? Can you go out and buy a maker of goods in anything from ice cream to home cleaners to hair tools?
In the last 16 years, the company's grown at a compounded annual growth rate of 20% a year during that period of time. We've never acquired a dollar of revenue in the company's history. It's all been organic growth. And today, we do over $4.5 billion on a trailing 12-month basis. Now, that's not to say we don't look at opportunities. Opportunities come our way all the time. It's just that we have a strong competency of growing organically. We think there's a lot of white space for new categories for us to enter into. Our international business is growing significantly. We're continuing to take market share in the existing categories. So I wouldn't rule it out, but I would say that right now we've got a really great playbook of organic growth.
And Mark, of course, we're just a couple months away from the U.S. presidential election, and it was interesting to see the comments on tariffs in your earnings call. One thing that stuck out to me was that you have the capacity and you're on track to move almost all of your U.S. volume outside of China by the end of 2025. How should we read that? I mean, is that basically a hedge for if Donald Trump resumes his presidency, actually wins the presidency again, or could actually Kamala Harris taking the office in November change your plans there?
Well, we started diversifying our supply chain really 5 years ago, and we started making our first products outside of China almost 4.5 years ago. Today, we make nearly all of our 301 tariffs currently outside of China. By the end of this year, about 60% of our U.S. production will be made outside of China. And as you said, we publicly stated that 100% of our U.S. production will be made outside of China by the end of 2025. China remains a very strong manufacturing base for us. We have nearly 1,000 associates, engineers, product developers that are based in China. So we think there'll still be a very strong presence in China, but we think that diversification of our supply chain is really what will help minimize any of the geopolitical challenges that might exist.
And I want to wrap this conversation into basically your plans for international expansion as well, because you think about Elon Musk, for example, even though, him and Donald Trump had that very cozy X session earlier this week. Elon Musk said recently that he was pausing a Mexico investment because of Trump, basically. And when you think about areas around the globe that you would like to expand into, I mean, how much of a factor is potential U.S. political risk there?
We've got a tremendous focus on expanding our brands and bringing our products to more homes around the world. That includes Latin America. That includes Europe. That includes the Middle East. Our business outside of North America is well over $1 billion in revenue, and it's growing at over 45%. So we think our products appeal to consumers globally. We think that consumers are really engaging with our brands, both the Shark and Ninja brands. And so we've really got our foot on the gas as it relates to international expansion and bringing our products, anywhere and everywhere around the world.
One thing that I think is pretty wild is the extended demand for your products. So Slushie, for example, you had recently told investors that you have a wait list of more than 100,000 units for the Slushie alone. And it will take some time to get those products into the hands of consumers. With wait lists this long, are you worried about your inventory at all? I mean, at what point do consumers drop off from having to wait?
Well, look, as you said, we launched our Ninja Slushie product, and today we have over 100,000 people on the wait list. We think that that product really hit a nerve of something that will create tremendous excitement in the consumer's home. Everything from, children, making juice slushies, all the way up to retirees, putting rosé wine into their slushie machine. Our supply chain will take some time to be able to catch up to that. I mean, it's very challenging to forecast the demand that we've seen from this. But we think as we get to the holiday season, we will catch up. We will be able to support the demand that we're seeing, and we're expecting a great holiday season on that product.
All right, Mark, really great to get some time with you. Appreciate you stopping by. That, of course, is Mark Barrocas. He is the CEO of SharkNinja. SharkNinja shares up 75% year to date. Let's get a check on these broader markets now with Bloomberg's Jess Menton.
Well, Katie, looking at the S&P 500, taking a dip lower here, down about 0.2%. Got close to that 50-day moving average around 54, but nonetheless still trading above that 100-day moving average above and around 5,300 here. If you're looking at some of the individual movers that are weighing on the broader index, it's chip stocks. So if you look at stocks like Nvidia and AMD, those are lower. But if you want to look at a bright spot in the chip component type space, Micron Technology still actually higher today after it got that upgrade, and still reiterating a buy rating from New Street Research as far as that, and looking at a $150 price target. But when you do have heavyweights like this that are weighing on the S&P 500, probably not surprisingly, it's going to pull a little bit lower here. Tesla actually rallied over 5% yesterday, so you're seeing it give back some of those gains. And we talked about Alphabet earlier today, and especially when it comes to the Department of Justice kind of mulling this idea with this landmark antitrust case about whether or not to potentially break up the company. So you're seeing that stock extending some of those declines, getting closer to about more than 3% at this point. But y'all just had this great interview with the SharkNinja CEO, but we're going to have another update on the consumer and retail tomorrow. So keeping a close eye at 8:30 a.m. Washington time tomorrow when we get those retail sales numbers. Looking at the month over month, about 0.4% gain if you're looking at the July reading here. But then also can't forget when it comes to earnings, we're going to have Walmart, the world's largest retailer, reporting those results. And if you look back to May, actually this company and the stock in general has been on a strong run this year, up over 40%. So back in May, it actually talked about how more wealthier shoppers were flocking to this particular retailer. So it's going to be interesting to see what they're going to tell on the consumer, because we'll have more retailers coming up next week when it comes to Macy's as well as Target, guys.
Jess, thank you so much for keeping it all eyes on the economic and consumer data out there, and of course those company stories. And coming up, candy giant Mars forking up $36 billion to buy the maker of Pop-Tarts and Pringles, Kellanova. We're going to discuss consolidation across the food industry here and exactly what's driving it. Stick with us. This is Bloomberg.
All right, a stock that we have our eyes on this morning is Cisco. The communications equipment giant is set to report earnings after the bell today. The results will provide data into if the companies that we're watching are back to investing in computer networks. Here are the preview is Woo Jin Ho of Bloomberg Intelligence. And Woo Jin, I would think, you know, with the AI craze, they better do well or they'll be punished. They'll be punished by this market. Is that how it looks?
Yeah. Well, quite the contrary, Matt. If you think about Cisco, they're actually a business in transition right now. You know, right now they're still customers are still digesting excess inventory. I do expect the fourth quarter to be the bottom. They've already gotten into 2025, and I do expect them to have a steady recovery. With respect to the AI business, look, they have $1 billion in AI orders. In the books. The issue is that $1 billion on a $54 billion revenue stream, it's pretty small.
Let's talk also about the bottom line, because ultimately the ability for Cisco to really improve margins here and improve expenses is really in part contingent on their headcount. And there have been recent reports of headcount reductions. How do you see that playing out?
Yeah, that's a fantastic question. Look, the reports are that they will have about another 4,000 headcount reduction. That's about 5% of the total workforce. That would be the second round of headcounts. Now, when they announced their first round of headcounts a couple of quarters back, we didn't think it was enough. I do think that this round would be enough. That would raise the operating margins by about another 100 basis points to about 33 to 34% if they're able to realize all of those cuts. So it's in the right direction.
All right, gotta leave it there. Really appreciate the time. That, of course, is Woo Jin Ho of Bloomberg Intelligence. Another stock, of course, we're keeping an eye on. We've been talking about it all morning. It's Kellanova. Mars buying the Snap brand for $36 billion, bringing together two major food companies into one. The deal set to be the biggest of this year. And joining us now is Jennifer Bartasha. She is Bloomberg Intelligence senior analyst for retail staples and packaged food. And Jennifer, I mean, it makes sense fundamentally, of course, diversifying away from just those chocolate products. But tell us about what this could mean for the global reach of Mars.
Yeah, so this actually will help Mars with its global reach. They already have sort of a top 3 market share position in most major geographies. But what Kellanova brings are growth brands, especially in emerging markets. And that should really help Mars penetrate those markets a little bit further and raise its overall global share. At the moment, the combined entity would in snack foods would bring it to about 6.2% of global share. And that would be the 3rd largest in the world. So, Mars is certainly going to benefit from a consolidation of that market share.
They want to diversify away from cocoa, and I guess prices have been at historic highs right now. What's going on in that market?
Well, with cocoa, there are some structural issues that we've been calling out within Bloomberg Intelligence, where we think that although cocoa prices have started to come down, they're going to remain elevated for quite some time. And that has to do with tree disease. It has to do with the perception about labor with the cocoa market and things like that. So this move actually does really help Mars diversify away from just being so much of a confectionery-focused player. But it is worth noting that when you look at Mars and their total sales, confectionery and snacking is a smaller part of their portfolio. They actually have a very large portion of their sales, almost 60% coming from pet food, because they are the owners of Pedigree and Whiskas brands as well. So this just furthers that diversification and then helps them bolster the size of the snack part of their portfolio.
Another question I have about this is who the winners and losers are. At the end of the day, Kellanova was a company that was previously associated with Kellogg, and they had separated these two businesses. You're at a moment now where Mars is just gaining not only global scale, but expanding into businesses not traditionally known to them. So who is the biggest loser, let's say, in this scenario? Who will have to compete more with Mars?
So I think when, the combination of these two entities is, certainly something that Mondelez has to watch out for, just because that is a global snacking company. They've done a lot with regards to biscuits and confectionery, as everyone knows. It's also competing more directly with Hershey, which has been investing in salty snacks over the last few years. And you can't forget the dominant player of PepsiCo, where we estimate globally between 40 and 45% of their sales come from snacks. So, those are the companies that really need to keep an eye on what's happening with this new combined entity.
So, of course, a big shakeup there in the competitive landscape of the snacking business. Before we let you go, just quickly, of course, we're looking forward to Walmart earnings as well coming tomorrow. You think about all the consternation over the state of the consumer right now. Walmart really a bellwether. What are you expecting?
Well, we're expecting that Walmart will actually have a pretty good quarter. They have, continued to drive share in essentials. So when you're talking about grocery and household supplies, they've been taking share from other players in that space. We heard them talk in May about attracting more higher income households into Walmart. We think that those trends are going to continue and that they should have a solid quarter. Companies like Walmart do very, very well when consumers are under pressure and they're looking for value. And so there's nothing that we are seeing that would disrupt that trajectory that they're on.
Jennifer Bartashis of Bloomberg Intelligence, we thank you very much for keeping an eye, of course, on the year's biggest deal, as well as some very critical earnings this week. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. Stick with us. This is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get to your trading diary for you, what you need to be watching this week, the rest of the week, I guess. Tomorrow we get retail sales data plus earnings from Walmart and Deere, and those two companies will tell us a lot about this economy. Friday we get U.S. housing starts, plus we get University of Michigan consumer sentiment data, and then we hear from Chicago Fed President Austin Goolsbee in the afternoon.
All right, let's take a check on these markets, of course. It's interesting. You wouldn't necessarily know it by looking at the S&P 500, which is just about flat right now. But an interesting reversal, of course, after we saw those huge gains yesterday. That index was up 1.7% after that softer than expected PPI. And of course, we heard from Mona Mahajan earlier today that that's when all the good news for the CPI print that we got this morning was priced in. Of course, that came in bang in line, but that just wasn't enough to continue that momentum that we saw from
Fun
yesterday.
fact, biggest decliner today in the NASDAQ. Starbucks.
Oh, there you
Down
go.
more than 3.8%. Really just giving up some of that exuberance yesterday.
I would have shorted that yesterday.
Oh, God.
Just from hiring one guy, it's not going to bring a lot of people back to
Key
expensive
man risk.
coffee.
Intraday key man risk.
And maybe even if he does work magic, though, it's going to take time, right?
Yeah.
It's not something that happens overnight.
Chipotle, though, holding its losses.
Chipotle.
Fun fact.
I went into Chipotle yesterday. I told the employees that their CEO was quitting.
I'm going
Were
into
they
Chipotle
devastated?
They didn't
today.
care.
No.
Well, that's a whole other story. But anyways.
All right, so I think it's very interesting that we got some Fed speakers come out the last couple of days and say, you know what, we don't necessarily need to cut rates at this meeting. Bostic, for example, Mckee Bowman. So we're really needing to see some more data, at least for those Fed speakers, before they are willing to go even 25 basis points.
Is king in this market. But stick with us through this week. Of course, Matt and Katie, I'm off this week, but they'll be joined by Priceline CEO Brett Keller and Evite CEO later in the week. This is Bloomberg.